It is Wednesday, December 19th, 2018. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was a very fun get your ass kicked at Jiu-Jitsu Wednesday. Unfortunately, I made the biggest mistake I've made in a long time. I fucking managed to forget my gi. Can you believe that shit? I managed to get all the way out the door, halfway to the school. Actually, no, I got all the way to the school before I realized I did not have my gi jacket. Oh well, I managed to get by with no gi. However, one of the techniques that we worked today involved an Ezekiel choke. So, me being short and having not really the longest arms in the world, had a lot of difficulty trying to adapt to that one. I just went for the arm triangle instead. But nonetheless, it was a pretty good class. It happened again though that I tried to get there early, and I tried to leave here early, but that did not happen. I swear, I'm going to break the Vex right now. I am going to be on time to the next class. That's it. It's done. Anyway, so as far as what we covered, though, it was some stuff from the top side control, I think. No. I'm trying to remember the initiating move, whether or not it was a knee shield or something to that effect. No knee shield. Just if somebody were laying virtually flat but managed to get in an underhook, that the way out of it and getting to a much more superior position, that was what we covered today. And it seemed to me that we covered some other shit too. I don't know, I'm drawing a blank. You know, not having a gi top really fucked me up. I mean, because it's like, there's so much of what we're doing in Jiu-Jitsu that, or at least that I'm doing in Jiu-Jitsu, that involves the gi. And even in sparring, it's not as easy, you know. Although I did not get to spar today, I was a little disappointed in that. Just wasn't quick enough in picking a partner, and there's one guy in the class, and he was available, but unfortunately he's got a broken rib at the moment, so he's really been resisting the temptation to roll, and it's very difficult. I mean, he's obviously far more disciplined than I am on that, because he wears a gi to class. If I'm that injured that I can't roll, I will not. I will not wear a gi top. You know, I'll actually intentionally show up with that gi top on, and instead I'll wear a hoodie. You know, and so I don't know. I guess I'm kind of rare in that I don't think injuries are something you should just like push through. You know, I mean, instead of doing the thing that continues to hurt you, you adapt your game to make up for the injury. Like, I've got 2 significant injuries at this point, but both of them I managed to work around, although I did bang my elbow this one time today, and it did not feel good, but I did manage to adapt my movement to where I wasn't hitting it again and again and again and again and again. And so, you know, that's what I mean by, you know, trying to be conscious of your injuries. But I was talking to a friend in Jiu-Jitsu the other day about this, and it really makes me want to get back into yoga, is that when I was doing yoga quite a bit, I noticed that if I had something like a twisted ankle, or, you know, a significant bruise or something like that, that I could get it to heal really quickly, you know, within like 3 to 5 days, whereas normally it would be a week or so, you know, that I was feeling it, that within a couple days the bruising would be gone, the swelling would be down, and I'd be ready to go again. And I really think there is something to yoga, the way that it enhances the blood flow through your muscles and stuff like that, that it helps you heal up a bit quicker. So, it's one of those things that I've been kind of fighting with, is that, I live out here in the boonies and my vehicle isn't exactly the most dependable in the world. So I'm a little hesitant to be driving back and forth to town just to do jiu-jitsu and yoga and jiu-jitsu and yoga. Kind of put a bit of wear on my vehicle. At least I don't think the current one I have would be able to make it out all that long doing that. I mean, it's just barely kicking by with me just dragging it to jiu-jitsu, so it's definitely time to replace it. Or it's been past time to replace it, actually. I don't know. I've always had a long relationship with vehicles. My first truck, I had it for almost about a decade. I don't know. I'm not really tough on my vehicles, and so they survive very, very well with me driving them. Anyway, let's go ahead and throw down into some music. I'm feeling a little sparse on our warm-up today, but the not having a gi top, that really fucked me up. I kind of cut into my meditations a little too deeply. And plus the fact that we were doing an Ezekiel choke tonight. I mean, we haven't done Ezekiel chokes in I don't know, I want to say 4 months, something like that, since we've done any kind of Ezekiel choke or any kind of reaching into the cuff of your own sleeve choke. And for whatever reason, tonight was the night that I didn't have a fucking gi top on. Can you believe that shit? Coincidence. It's just a coincidence. Anyway, like I said, let's go ahead and throw down into some music. And, I'm feeling like this tonight. Body Count, Bloodlust, First Dance, here on Coin Metal.
Since the beginning of time, humans have killed each other because they did.
And that was Megadeth with Last Rites, Love to Death. I always remember that song from the first recording of it, and in all honesty, the first recording of it was much, much better. I don't know if it was, they were really, really rushed or whatever when this thing was released, but out of all the remasters, I think that is probably the poorest remaster of a previously released work that I've heard a major band do. And I happen to be a really big Megadeth fan, so that was kind of disappointing. I mean, I don't. It makes me wonder what was going on. It's did they have some sort of issues in the band during the recording of it that was drawing attention away from the actual production itself? I don't know. I wasn't there. All I know is that for somebody as meticulous as Dave Mustaine is, I imagine that there was some exogenous fucking force, don't know what it was, but that was really rushing or putting other pressure on the actual production, because like I said, I think the original release of that was much better. And that's one of the things about remasters. I mean, you're trying to make it better, right? It's like the Meshuggah Nothing, the album Nothing. The one that I play on here is actually a remaster. And it's as good, if not just a teeny tiny better than the original, I think. There were just one or two little spots where I'm just I don't know that was the best way to go about it, but again, I'm not the one that makes those calls. Bands do the things that they do for a lot of reasons that we will never know. Just not really something that we need to know, because they're people, and they have people issues just like the rest of us do. Anywho, I was digging around for stuff to talk about today, and because I like to do this show completely by the seat of my pants, because I find that I get the best material just looking around like this, where it's not something that I actually had open. It's not something that I intended to talk about, but it is certainly interesting. And so here it is. This is on chepicap.com. Professional investors are pulling out of crypto. And this is by Arthur Sellers, author December 19th, 2018. And it doesn't give us an actual time or a time zone. But yes, penis. Oh, let's see here. I'm trying to check something really quick. It looks like... No, okay. I want to make sure that this isn't just an aggregated article. And so I'm opening it up in it. Yeah, okay. Well, actually, this one's on Bloomberg. And for some reason, they got some fucking autoplay bullshit on there. Anyway, this is on Bloomberg.com. Pros are ditching the Bitcoin market, JP Morgan says. And this is by Gregor Stewart Hunter, authored December 18th, 2018 at 4:38 a.m. PST. Okay, so... And I guess this was updated after his workout at 8:25 a.m. too. So anyway, at least we know where he was and that he does have a penis. The prolonged digital asset slump is scaring off institutional players, according to J.P. Morgan Chase & Co., suggesting a fulcrum for cryptocurrency markets is giving way. Quote, participation by financial institutions in Bitcoin trading appears to be fading. Analysts, including Nicholas Penegurtsalu, wrote in a research note dated December 14th, quote, key flow metrics have downshifted dramatically, including in futures markets and in average volumes, they said. While the surge of institutional interest a year ago was cheered by cryptocurrency enthusiasts as a signal the industry was here to stay, last December's debut of Bitcoin futures, a key product for professionals, also coincided with Bitcoin's apex. Meanwhile, open interest on CBOE global markets has dwindled and in the past month reached the lowest levels since trading began a year ago. An equivalent gauge for the more widely used contract on CME is near the bottom of 2018's range, according to data from the Commodities Futures Trading Commission. The daily median transaction size, which reached highs of around $5,000 a year ago during the speculative frenzy, has fallen off to less than $160, the report said, citing data from bitinfocharts.com. After the speculative bubble in digital assets burst last year, markets have pummeled Bitcoin, the most valuable and well-known cryptocurrency. Since peaking at highs of $19,511 a year ago, the token has lost more than... It's not a token, dude, it's a cryptocurrency. Has lost more than 80% of its value. These sell-offs spilled over into a host of alternatives, including Ethereum, Ripple, and Litecoin. For a look at crypto's boom and bust, click here. Other cryptocurrencies continue to suffer disproportionately during this correction phase, JPM's note added. Other analysts may gauge institutional interest differently. For Bloomberg Intelligence's Mike McLone, the decline in Bitcoin's price distorts what he considers to be actually increased interest. The sheer number of combined contracts from the two venues is set to end the year at an all-time high, he said. In any event, the declines have forced some unprofitable Bitcoin miners to exit the market. Miners provide the server power that underpins transactions on the blockchain. No, that's not really it. No. They mine the transactions and make the blockchain and receive new supplies of currency as a reward. At least they got that part right. The Bitcoin hash rate, a measurement of computational difficulty in running a blockchain that's used as a proxy for mining activity, has declined since October this year, according to blockchain.com. Quote, this suggests that prices have declined to a point where mining is becoming uneconomical for some miners who have responded by turning their mining rigs off, JP Morgan said. On the one-year anniversary of Bitcoin's peak, the token was 1.1% higher at $3,534 as of 11:12 a.m. in New York, headed towards its first two-day gain in December, excluding weekends. On Monday, it leaped 11%. Quote, sharp rallies should expected as dude, you left out the word be. Should be expected, as the market is extremely oversold by most metrics, McGlone said, pointing to the relative strength index. Quote, record shorts and extreme discounts to most moving averages. At the same time, compared with last December, this month is witnessing more end of the year, quote, just get me out of bubble bursting tax-related and fundraising selling, he said. Somebody messaged me on Discord here. Where is it? Oh, damn it. I hate Discord for this reason. Anywho, so yeah, it seems like the institutional players are starting to dip out, and that's something kind of predictable. You know, they like really rosy markets, and things get offset, and they immediately want to evacuate the more speculative aspects of their portfolios. And unfortunately for us at this moment, cryptocurrencies are among that category. You know, I saw another article on one of these other websites. Blah, blah, blah. Damn, lost it. Anyway, so yeah, I think that institutionals have shifted gears. A lot of them have shifted to being hodlers. I was reading some other place that I guess this one address has been receiving about like 250 Bitcoin a day. That's a lot of fucking Bitcoin, dude. But I don't know, like, whether or not how they're aggregating the Bitcoin or whatever. But yeah, apparently they're just all going to this one wallet. And so I mean that tells me that it's institutional players, right? You know, I mean, they're the people with the liquidity, other than the miners, of course. But yeah, I think that the big boys are going to being hodlers, because I believe, anyway, that they intend to be the payment service providers in the Lightning Network kind of sphere of things. You know, I've often thought about the word blockchain and exactly what these people mean by that word. And sometimes I think they mean that they're going to be running their own servers and they're, you know, recording their own transactions on their own servers, and so basically it's just a big distributed database. Or number two, that they run their own sidechain off of Bitcoin. And so they're basically building on the work of the miners. And one little glitch that they did make note of in this article, they were talking about the decline in hash rate on the Bitcoin network. You know, that opens up some security issues. And I think this is one of the lessons that it's been a while since we've had to face in Bitcoin, or that we have faced it in Bitcoin. And I think it will express very interestingly. And another thing, though, and I was just thinking about this today, that I expect that the decline in hash rate on the Bitcoin network, and also the increase in value of alts, is going to stimulate more mining. But more importantly, mining has kind of had this issue where you have really, really expensive ASICs, and they're pretty much dominating the higher end of the market, right? But I keep talking about this on the show, and one of these days somebody's going to actually listen to me about this, that the improvements that they make in mining hardware, efficiency increases when they get the specs going down or a nanometer or two, on the dimensions of their circuitry and chip, that IP, that intellectual property, that data, that information, it doesn't just stay in one place. And when you've got entities like, say, Global Foundries, where they've got, or Samsung even, where they've got several different fabs, but they all have similar operating procedures, the specifications that they work within and stuff. And so in statistical process control, you want to eliminate your bottlenecks and push your efficiencies. And so it's a bottleneck to have to do things like retooling. If you've got one chipset that you're doing at 7 nanometers, you might as well upgrade as much shit as you can to be processed at that plant, because then it saves you having to retool anywhere else. Instead of at one site, you do the 9 nanometer spec stuff, and then you also do the 7 nanometer spec stuff, when you could just be dedicating your entire manufacturing floor to the 7 nanometer stuff and be processing the 9 nanometer stuff in an entirely different floor at an entirely different facility. Okay? And so when you look at it that way, it's like anything that you're trying to increase the efficiency on, you want to shrink it down. You want it to use less electricity and get the same amount of power out of it, if not more. And so the idea that you can scale down from 24 nanometers down to 7 nanometers in less than 2 years and not have some sort of glut or not have some sort of out of whack while everybody's trying to retool and shit is just silly. And I think that, we've had a little bit of waning interest in mining only because a lot of coins have gone down significantly in value. But I believe that the necessity for cryptocurrencies at this point to be able to use peer-to-peer and whatnot, I think that alone will continue interest and probably extend interest in the altcoin space. And this little ditty right here, I believe, would be interesting for it. Anyway, it's all tied in. Now let me get rid of this notification thingy. Oh, Jesus Christ. Continue with that, blocker. Thank you. Fuck you. Okay, and so this is on PCGamer.com. I actually had to hunt it down because it was aggregated from another site. This Radeon RX 580 graphics card is just $179 right now. This is by Corbin Davenport a day ago. One of the best cards around for a mid-range gaming PC. AMD's graphic cards have continued to drop in price ever since the cryptocurrency gold rush ended. It didn't end, it just subsided. It'll pick back up again. The 8GB Radeon RX 580 is a better deal than ever before, especially today, because you can get one for $179.99. Power Color's Red Dragon RX 580 has dropped to $179 on Newegg, which is around $10 to $30 cheaper than most other 8GB RX 580 cards. It has a boost clock of 1350 MHz and dual cooling fans. For output, you can get one HDMI, 3 DisplayPort, and one dual link DVI or DVI-D. The card also comes with 2 free games. You can choose between Division 2, Resident Evil 2, and Devil May Cry 5. Not a bad deal for under $200. No, that's pretty impressive. But I expect that to continue. That the clash between decline in interest in mining and also supply gluts, that we're going to see an increase in mining because the cards are going to come down cheaper. And I think that the longer term, that when the market actually kind of levels out a little bit between the expected distribution, the expected use, reuse, so on and so forth, where we are going to start to see video cards seriously competing with ASICs for efficiencies and for power, if not exceeding them. I think that again is an indicative of a little bit of a supply lapse. Where you had all the interest driving specifically to ASICs and making those as efficient as possible, and the visuals of the returns on that. It's like everybody looks at like Bitmain and they're looking at what they're getting per machine and they're like, dude, I want a piece of that shit. That money should be in my pocket. And the people saying that are like Asus, Samsung, Intel, IBM, all these motherfuckers. They're like, dude, I want that paper. I want that paper in my account. And so, like I said, a little improvement here, a little tweak there that you see in mining, that's going to transmit throughout the rest of the whether we're talking about video cards or laptops or tablets or any of that other shit, that if it's got circuits in it, if it's got a chipset in it, if it's got RAM in it, it's going to get smaller as a result of the improvements that we're making in mining, because mining is directly in, it's direct. It's you put the fucking hardware together, you hook it up with a goddamn mining pool, and you're making money from it. It's not something where you have to get the hardware and then you got to get the substrate and then you got to mold the substrate with the hardware and then you got to get that back out on eBay or some shit like that. No. You plug the hardware in, you set it up with an account, and you can make money with it. Because the return is that much quicker. I think that's one of the things that drives the interest in it, because the more efficient you can be at mining, the more money you make, right? And that's what everybody wants to do. Everybody wants to make money. Anyway, let's go ahead and throw back down into some music. I'm feeling the need for some Ministry. But what to play? Watch yourself. Oh, no. No, here it is. Rio Grande Blood. Here on Coin Metal. And that was Skindred with Nobody. Yeah, I think I just refined my explanations of what a blockchain is down to the finest granule that I possibly could. This guy, Genealogy on Twitter says, have we reached an agreed upon definition for blockchain? Friends, family, and sometimes co-workers ask me, what exactly is a blockchain? My reply is usually, and facial expressions that look like I don't really know. So what's the best way to describe it to a layperson, to describe to a layperson what a blockchain is? My reply is, it is what bullshit, blockchain, is to bulls, miners. No bulls, no bullshit. That's the long and short of it, baby. That's the best I can do you for. Oh God, I gotta take a moment to reply to this guy. No foot about it. On function of a money transmitter, a custodian, and then consider the function of many of the parties. I should really do this on a music break. This guy's kind of silly. Anyway, I did want to cover this aspect of what we've been talking about. There's been a lot of shifting around as far as the institutional interest in this space. And, I think it's just fine and dandy. They've been here since roughly 2012, in and out, all over the place, trying to figure out ways to become rent seekers in crypto as well as fiat. And there's no blaming them for that. Cryptocurrencies are about self-interest, and they act out of their own self-interest. This is a given. But it's also meant to incentivize you to mine it, because by mining it you get rewarded with the Bitcoin. Whereas rent seekers have been just trying to stay on the outside, not subject themselves to the quote-unquote volatility, and just play the edges and make the money off of it. Well, there's only so much that you can do before the rest of the market gets kind of tired of it, and they move their money elsewhere, their interests elsewhere. Anyway, so here we go. This is on dailyhodl.com, and this is authored December 18th, 2018, and it's by the Daily Hodl staff, I'm assuming. Hopefully it's not aggregated from somewhere else. But anyway, continuing on. Ripple says banks are not using XRP-powered XRapid or cryptocurrency due to regulatory uncertainty. No, they're just not using Ripple because it's not really a cryptocurrency. Continuing. Banks are hesitant to use Ripple's XRP-powered cross-border payment solution XRapid or any other cryptocurrency due to regulatory uncertainty, according to Ripple's global head of banking. At the Eurofinance Tech Conference in Frankfurt, Marjan Delantine explained why non-banking financial institutions and payment providers are the early adopters of the new technology. No. Let's see here. Quote, just to make clear, no banking institution is using that because, as you've probably heard about, the regulatory framework around usage of digital assets is not very clear for banks. But payment service providers and some other financial institutions are less governed by these obligations. However, they do have regulations of their own, as a lot of people seem to be forgetting. Delantine also lays out a typical use case for XRapid, using an example of someone sending a payment from US to Mexico. Quote, let's imagine you are in the US. You have $100 and you want to send that to a user or someone in Mexico. So, you go to the crypto exchange, you exchange $100 for XRP, and immediately after the XRP is converted back to Mexican pesos, if it is delivered either to the local or to the financial institution that has an account with the crypto exchange. So this is actually changing the way that the current liquidity is managed. So you only use the liquidity when you need it, and when you don't need it, you don't use it. So this product, I think, is somehow the ultimate way that we see crypto assets or digital assets can help build the global economy by using the costs associated to the liquidity management. Ripple launched XRapid for commercial use in October. So far, Ripple has confirmed at least 3 payment providers are on board, including MercuryFX, Coalix, and Catalyst Corporate Federal Credit Union. The regulatory uncertainty is a couple-fold. Number one, it's to keep people that would compete with existing entrenched interests from developing too hard a cement under themselves. They don't want you to be developing a bunch of shit and getting established, because they want Goldman Sachs in there and all those other guys. And so, they stall on defining anything. So your clients are like, so can you do this or can you not do this? And the other aspect of it is that, I think anyway, that they're trying to better understand what they can do as custodians with cryptocurrency in context of, how should I say this, using your funds while you're not using them. Like this guy's talking about how the funds are there when you need them, and where is it here? Crypto exchange. So you only use the liquidity. You only use the liquidity when you need it, and when you don't need it, you don't use it. Okay, so does that mean that somebody else is using it while I'm not using it? And so we're probably talking about fractional reserves, or using the volumes that are hosted or represented by a transaction initiated by someone else as the liquidity for some other venture. Or the collateral, rather. And probably the liquidity too. I've predicted for a long time. I've called this the GR Bufu, the Great Ripple Butt Fuck. And basically it's like this, where you get a series of fractional reserve tokens, tokens that are supposedly representing a portion of some cryptocurrency somewhere, right? And then you use those tokens to buy real tokens or fiat currency. You exchange them for fiat currency. So you have something that's not really worth anything, and then you exchange it for something that is worth something. And I've said multiple times on this show that cryptocurrencies are probably the most transparent currency that's ever been invented by man. And see, I believe that eventually the people will take notice of the distortions. That it's not something that you can hide forever. It's something where you hope to get away with it long enough to make a significant amount of money and then get the fuck out, right? But at some point you do have to cash out, and that ends up hurting a lot of people. And so anyway, I got this article here on Forbes, and I don't know if this is like FUD or what, but it seems pretty significant. And this one's on this one's by John Coetzee. And so yes, penis. Report: top crypto exchange BitThumb faking up to 94% of trading volume. BitThumb denies allegations. Of course they deny it. Pfft. No, we're not churning our own books. Cryptocurrency exchange rating service CER has accused Korea-based BitThumb, the world's second largest crypto exchange by volume, of faking much of its trading volume since late summer of 2018. In September, CER says BitThumb ranked at the bottom of the top 10 global exchanges as measured by CoinMarketCap, at around $350 million in daily trade volume. But by November 11th, BitThumb peaked at about $4.4 billion, more than 12 times as much. Today, BitThumb ranks second on CMC's list of crypto exchanges as measured by reported volume at $1.4 billion. BitThumb does not appear on CMC's adjusted volume ranking. The reason, according to CER, wash trading, or simultaneously selling and buying at the same time to create misleading and artificial activity. Quote, judging from our multifaceted investigation on BitThumb charts, We see the signs of trade volumes manipulations, specifically wash trading. CER marketing lead Gleb Mirko told me via Facebook Messenger, quote, "Having calculated price-volume correlation, we came to the conclusion that the trade volume performance is not linked to price fluctuation on the exchange." One example of odd trading patterns includes a 10x jump in BTC daily trade volume in September, which does not appear to be accompanied by fundamental causal factors. Other examples include strange activity spikes in the first few minutes of the 11 a.m. hour daily that delivered 95% of the daily total volume, and irregular trade volumes that didn't align with price moves, CER says. In addition, average transaction size ballooned from 0.21 BTC in the beginning of the summer to a very significant 5.88 BTC, or $37,600 USD from October 15th to November 11th. The trades followed an odd pattern as well. For example, Bitcoin transactions on September 9th totaled an astounding 7,500 in just 5 minutes. That's 39% of the day's total trades and 94% of the whole day's volume. According to CER, the other coins showed similar patterns, including LTC, ETC, XMR, ZEC, OMG, and BTG. One coin, WTC, showed the most intense artificial activity, CER says. WTC, what? Is that worm butthole token? WTC stands out from all the coins we observed as it's only listed on the exchange on the last day of August and had the shortest pump period, which started on October 28th and lasted until November 11th, CER states in a document shared with me. For that reason, its pump was one of the most intensive. The inflated daily volume of Walton Chain jumped by 350 times from 348,000 WTC on average prior to the pump to 122.5 million WTC on average during the pump, only to then drop by 1,450 times in one day from 206.7 million WTC to 140,800 WTC on November 12th. Pump and dump, yeah. I asked BitThumb about the allegations, and the company dismissed them out of hand. Quote, BitThumb is doing nothing to inflate trading volume, an unnamed company representative told me via email. Quote, BitThumb is not selling mining-based coins. BitThumb is trying to get more customers by providing various promotions, just like any other company in the world, as a normal business. CER is a service by Hacken Ecosystem, and Hacken offers a, quote, white hat community token. Concerned that these allegations might be motivated by business concerns, I asked Hacken if the company had ever tried to list on BitThumb. The answer, no, never. Cryptocurrency experts I spoke to did not find this kind of behavior difficult to believe, although they stressed that to elevate this specific accusation, they would need to review the evidence carefully. That said, there seems to be little trust in the crypto world, perhaps appropriate for currency which is supposed to function as in a trustless environment, or perhaps not. Quote, they all inflate numbers, says Ari Altshiel, CRO at Hexa Labs, a blockchain consultancy. Quote, it's the normal practice in crypto. All the non-US exchanges are inflating transactions, agrees Brandon Wirtz, CEO of AI company Recognant. adding that many in the U.S. are doing the same and using buffers between legitimate buy and sell bids to buy and resell coins between the kosher trades. Quote, "It causes volatility and velocity, which can be good for 50% plus more traffic," he said. Crystal Clear Stranger, founder and CEO of Pcounts, a blockchain-based payroll payments company, says that this is quite possible and even common. Quote, "In the crypto space, it is common to follow the adage of fake it till you make it, and many people grossly exaggerate how successful they are. Many companies have used market manipulators to pump the value of their tokens to look successful, and other exchanges have done this to break into the top 10. Quote, "It is very easy for a centralized exchange to trade dummy accounts and off-chain using bots to pop volumes," Stranger added. Quote, "And it is the exchange themselves bear little cost for these transactions, essentially just the computing cost. It becomes very tempting, especially with so many exchanges opening in the last couple years. It is a very competitive market." Another expert suggested that this could be connected to BitThumb's well-publicized hacks in 2017 and 2018. Quote, "Originally, the breach on June 19th was thought to have resulted in stolen crypto being sent to unknown hacker wallets," says Morgan Steckler, CEO of iTrust Capital, a digital currency retirement planning company. However, if this recent fraudulent transaction data proves to be true, and if BitThumb was able to evade detection through multiple recent audits of their security and transaction protocols, it is also entirely possible that the 39 addresses thought to belong to the hackers actually belong to the exchange itself. Several experts did not want to be named. Gosh, I wonder why. Shit like that might get you assassinated. Quote, "Basically, take all the illegal stock trading activities that have been banned over the years and move them into crypto. Why? Because it's the wild, wild west," said one who manages companies on both the fiat and cryptocurrency sides of finance. Quote, "Ghost orders are huge. It's where you open a buy and sell at the same time across multiple accounts, and then close off one side of all the transactions, example buy side, and then run with your short position sell side." Another expert suggests that BitThumb may have inadvertently contributed to Bitcoin's continuing price collapse. Inadvertent, my ass. Quote, "According to the data reported by CCN, there is certainly evidence to suggest a strong correlation between the timing of BitThumb's promotion expiration and the sudden and for many shocking plummet that continues to play out across the industry," says Travis Barker, CTO of Dash Marketing and an early adopter and proponent of cryptocurrencies. Quote, "So far, I haven't seen evidence to suggest malicious intent. In other words, I don't know if BitThumb was intentionally or incorrectly inflating volume numbers or simply running highly successful promotions to that effect. I would say it could be either way. This is crypto." CER representatives seem fairly certain that there was intentional malfeasance, and I would contend that's certainly a possibility. Quote, "BitThumb has mastered a multi-factored approach to conceal its foul plays," says CER's Mirko. "As far as we are able to judge, the manipulations were fulfilled via matching opposite orders with the same price or by simply drawing transactions out of thin air, so-called painting the tape. The goal, CER suggests, may have been to establish BitThumb as a leading global crypto exchange. The result, however, could be extremely negative. It undermined the entire image of the blockchain sphere as an environment of trust and transparency, says Mirko. No, it didn't. It actually proved that the transparency is effective in rooting this shit out, because that's where you're deriving your metrics from, is the transparency of cryptocurrencies. Continuing on. Says Mirko, quote, such irresponsible activity makes crypto feel less than unwelcoming for investors and industries who saw blockchain as a new opportunity. Yeah, dude, if you saw quote-unquote blockchain as a new opportunity, yeah, maybe you should be scared off. I'm sorry, if you can't be bothered to understand the terminology that you're using and how it relates to the technology that you're talking about, then really, you're probably going to get wrecked, and it would be better that you weren't involved. Take the time to read. You still have plenty of time. We're just starting with this shit. We're decade 1 into this monetary standard. Continuing on. All that said, it's important to reiterate that BitThumb denies the accusations. CER is planning to publish all of its data, over 20 pages of charts, images, and documentation of what it considers to be fraudulent behavior. Dude, if it's 20 pages and it's got enough text data that like describes the charts that we're seeing, I'll be more than happy to cover it on the show. At that point, BitThumb will be able to respond directly to the accusations and perhaps offer an explanation. I forecast and analyze trends affecting the mobile ecosystem. I've been a journalist and blah, blah, blah. That's just a reporter. So, yeah, Joan Coetzee, thank you, sir. Yeah, BitThumb, somebody got wrecked. And I don't know who it was, but there's like 4 entities that are very, very closely related, and BitThumb is one of them. You got Bitfinex, Tether, BitThumb, and then there's one other, and I can't remember what it was. But they're all very, very tightly knit. They're all based with the same monies. Anyway, something to take note of here, though. I would be willing to bet that all of these coins, Bitcoin, Litecoin, Ethereum Classic, XMR, or Monero rather, ZEC, and I can't remember if that's Zero Coin or something, or I don't know, Zcash, OMG, and Bitcoin Gold. I would be willing to bet that they all have a pairing against a quote-unquote stable coin on BitThumb. Yeah. I think that stable coins represent a potential for a lot of abuse in the cryptocurrency space. I regard them as counterfeit US dollars or other fiat currency. That I don't really believe that they have the volumes of cash that they say they do, being subjected to the risk of putting it out there as a quote unquote stable coin. I don't believe it. I believe it's much easier for them to just claim that it is, and there you go. But this right here might be kind of interesting. It might be a worthy pursuit for anybody who is attempting to try to incorporate cryptocurrencies with their business, either through quote unquote blockchain or Bitcoin or other cryptocurrency. And this one's on blog.coinbase.com. Earn cryptocurrency while learning about new digital assets. And so this is by Coinbase. It's written on December 19th. We're launching Coinbase Earn in invite-only mode today. Coinbase's mission is to create an open financial system where anyone in the world can participate on equal terms from their computer or smartphone. To bring this vision about, we'll need to make blockchain technology more accessible, both in the sense of making cryptocurrencies easier to obtain and easier to understand. That's where Coinbase Earn comes in. Coinbase Earn allows users to earn cryptocurrencies while learning about them in a simple and engaging way. The idea is for users to understand more about the asset's utility and its underlying technology while getting a bit of the asset to try out. To manage demand, we're launching Coinbase Earn Today in invite-only mode with a single asset, ZRX. Over time, we plan to add more educational content as well as the ability to earn other cryptocurrencies. If you received an invite to Coinbase Earn by email, you can go to the Coinbase Earn ZRX page to earn small amounts of cryptocurrency by completing educational tasks like short video lessons and quizzes. But if you haven't received an invite yet, don't worry. You can still view all the educational content on Coinbase Earn page for free and sign up on the waitlist to be notified as more educational tasks are available. Learn simple and engaging cryptocurrency education. In a survey of Coinbase customers and non-customers alike, we found that one of the biggest barriers preventing people from exploring a new digital asset was a lack of knowledge about that asset. Many of the people we surveyed expressed a strong desire to begin learning about new and different crypto assets beyond Bitcoin, but didn't know where to begin. That's why we're launching Coinbase Earn with tasks related to asset education. The educational content will be publicly available for any curious party to learn more about an asset, even if they haven't yet received an invite to begin earning. Earn, a new way to access cryptocurrency. Traditionally, the two ways people have obtained cryptocurrency are through either mining or buying. Mining cryptocurrency typically requires technical knowledge and high upfront costs, while buying cryptocurrency can require disposable income to exchange for cryptocurrencies. Earning cryptocurrency is the third option. It has the potential to expand the blockchain user base from the tens of millions of people with the resources to mine or buy crypto to the billions of people who now have smartphones. This is because one can, in theory, earn crypto simply by clicking buttons on a laptop or phone. Coinbase Earn solves many of the practical issues required to turn this theory into practice. We give verified, invited users a series of useful tasks to complete from anywhere to earn digital currency. For this first set of tasks, funding is coming from the OX external development pool, with 100% of the funds going directly to users. In the future, we may experiment with other kinds of tasks from different types of senders, not necessarily always created by asset developers themselves. For example, there may be tasks paid in Bitcoin that aren't sent by Satoshi Nakamoto. We think Coinbase Earn could help open up blockchain access to a new group of users, people who are curious about digital assets but who'd like to try them out for free, just like a normal web or mobile app. By serving that need, we hope to make blockchain more accessible in the process. Please check out the Coinbase Earn page for ZRX today. That's interesting. You know, it's not entirely true that there's only 3 ways to get it now. There was also the idea of giving cryptocurrencies, and this is something that was going on quite a bit during the last alt bloom, and I think that's probably something that we're going to see again. You know, that people are going to be giving away coins just to get them into the hands of people, and I don't think that I don't think that's a bad way to get in. I mean, I certainly helped plenty of people onboard into Verge that way, and so, you know, it's a good way to do it. You know, you give them something and they figure out how to use it, and that's pretty much it. You know, I mean, I gave away plenty of Verge. Actually, I gave plenty away when it was still Dogecoin dark. But, it cost me dearly too, man. I gave away a shit ton. I mean, I would certainly like to have those coins today, but, hey. I think exposing other people to it was more than worth the cost. And you really can't overlook that as an option. If you're trying to get some traction with your coin, give some away. Give people the option to mine it. Show them where. It all helps. Anyway, let's go ahead and throw back down into some music. And I want some Sixth, The Scent of the Obscene, here on Coin Metal. And that was Rivers of Nile with A Home. And so, as we were saying on the other side of the music break, it seems that there have been multiple fluctuations within the interest of institutionals in cryptocurrency. And this is kind of the other side of it here. It's on BitcoinExchangeGuide.com. NASDAQ still interested in Bitcoin futures launch in early 2019 despite ongoing crypto price drop. And this is by Christy M. November 27th, 2018. Dude, this is fucking old. Never mind. I'm not going to go into it. I probably actually read this fucking thing to begin with on this show at one point or another. But I do have another article. And this one is much more recent. As a matter of fact, this one is from the future. This is on EthereumWorldNews.com. Analysis: Crypto investors have been buying the Bitcoin dip. And this by Nick Chong, authored December 20th, 2018. And so, yeah, from the future. Bitcoin fans stockpiling amid dip. Although many have claimed that cryptocurrencies, namely Bitcoin, have finally bitten the dust in 2018's market downturn, data indicates that many investors still see copious amounts of value in blockchain-based assets. Per a report from Bloomberg News, Olga Karif, which directly cited data from blockchain analytics unit Chainalysis, Bitcoin has continued to flow into the addresses of, quote, personal wallets, not just exchanges. The research group divulged that the 30-day moving average of Bitcoin flow into investors' wallets has been on the rise, eclipsing the $400 million milestone as of November 1st. Although $400 million out of the Bitcoin's current $65 billion market capitalization isn't especially notable, considering that in June this same figure was $300 million, with the price of Bitcoin at $6,000 instead of $3,750 at time of writing. November's inflows should be seen as a bullish indicator. In an interview, Kim Grauer, an economist at the blockchain data firm, explained that this data suggests that investors have sought to accumulate Bitcoin at lower prices, which lines up with community sentiment at large. Peter Brand, for instance, explained that he has started to allocate more capital towards Bitcoin due to his long-term belief in the asset's underlying value. Oh, blockchain. Grayscale Investments now owns 1% of all Bitcoin. Holy crap. Not only have, quote, personal wallets seen an auspicious increase in Bitcoin address balances, so have institutional players via Grayscale Investment, an investment-centric subsidiary of the conglomerate that is Digital Currency Group, DCG. Since the start of 2018, Grayscale, headed by Michael Sonnenschein, has seen its Bitcoin coffers swell by 30,600 Bitcoin to 203,000 Bitcoin total, now accumulating for more than 1% of the asset's total circulating supply. Actually, that's kind of off, I think. Anyway, continuing on. As seen in the chart above, sourced from Longhash, the wallets pertaining to Grayscale's GBTC, a vehicle that allows retail investors to purchase custodied Bitcoin on the OTC market, has seen month-over-month increases. Cyprus-based Dyer wrote on the matter, quote, record inflows, however, resulted in record Bitcoin equivalent holdings, with December notching up a little versus the start of the previous month. Although GBTC's user base also consists of retail investors, the steady rise in Bitcoin holdings indicates that capital continues to flow into this market through trusted third parties, ironically enough. A plausible positive sign. Actually, it's a stupid fucking sign, really. It's just stupid people getting involved. Ethereum whales also accumulating. Accumulation hasn't only been limited to the Bitcoin investment scene. Per data compiled by token analyst routed through Dyer since January 2018, the amount of Ethereum that Ethereum's top 500 wallets have held has increased by 80%. That's a lot. To put this growth figure into perspective, on January 1st, whales kept 11 million Ether under lock and key. As of November 30th, the same group of users holds 20 million. This job-dropping sum amounts to approximately 15% of all Ether currently circulating and $2.2 billion in US dollar values. Pardon me. Clearly indicating that whales are heavily betting on a market reversal. Yeah, me too, kind of. Regardless of the exact stimulus behind this bout of accumulation, Dyer explained that while fiat value of whales holdings has fallen by 90%, Q4's Ethereum balance growth is up 270% over Q3, a bullish sign, especially in the eyes of optimists. Yeah, anybody holding, basically. Oh, wow. But apparently this hasn't been enough to convince all people. I've got this other article here. And I think this is kind of an interesting call, especially considering the duration of the quote-unquote pump. It's on EthereumWorldNews.com. Trader, Bitcoin above 4K is dead cat bounce. Crypto still in strong downtrend. This is by Nick Chong, December 20th, 2018. Again, from the future. Meet Peter Brand. Peter Brand is likely a name you have heard thrown around in the cryptosphere in recent years. Brand, for those who are unaware, is a commodities market trader with decades of experience and newfound-ish Bitcoin. Although the American trader has taken a liking to the flagship cryptocurrency, nearly 1 year ago, on January 22nd, Brand called for Bitcoin to pull back drastically, citing a, quote, general technical analysis rule. At the time, in a tweet that has since garnered 3,300 likes, the chartist explained that after a parabolic advance in markets, an 80+% decline in value is expected to occur. By the same token, Brand traced out an 80% decline for Bitcoin, which would see the blockchain-based asset fall to $39.33. After Brand has been lambasted, crucified, and excommunicated for his bear call, his forecast has come to fruition. And this hasn't gone unnoticed. Trader, analyst, and commentator Infamous, who goes by the Twitter handle InfamousXBT, recently posted the tweet below, which seemingly poked fun at the crypto community's reaction to Brand's sub $4,000 forecast. Crypto Twitter welcoming Peter Brand after successfully calling an 80% plus decline in Bitcoin value after its parabolic advance. Yeah, cool. Broken clock is right twice a day. Some discussed his call with a bit more skepticism. Bitlord, a quote full-time crypto enthusiast since 2012, claimed that Brent made a chart depicting Bitcoin heading to $50,000 but deleted it to run with the $4,000 narrative. Ethereum World News is unable to confirm if this is accurate, but this isn't out of the realm of possibility. And here's the tweet to that Bitlord put up. Everyone forgot Peter Brandt made a $50,000 Bitcoin chart and just deleted it to run with the $4,000 narrative. That's how he got the name Peter the Deleter. That's funny, Bitlord. Nevertheless, regardless, at the time of writing, Bitcoin remains below Brandt's target by $250, deeming his call an undoubted success in spite of the nuances and caveats. Bitcoin remains in quote a strong downtrend, yet crypto will eventually get exciting again. Now, many months later, Brandt has another prediction for the cryptocurrency market, specifically pertaining to Bitcoin. Speaking with Yahoo Finance, the current CEO of Factor LLC noted that he doesn't expect Bitcoin to go anywhere, explaining that at best the asset could reach $4,600 in the near future. Still, he added that if Bitcoin breaks above $4,000, such a move could likely be classified as a dead cat bounce, rather than a long-term trend reversal. A dead cat bounce is, of course, when an asset rallies after a sharp downturn, but falls further afterward. If such a move materializes and Bitcoin breaks under $3,000 in Q1 of 2019, he expects for Bitcoin to continue to $1,200 due to the asset being situated in the midst of a quote strong downtrend channel. Although he painted a dismal picture for the short-term future of crypto markets, Brand noted that eventually he believes that it, quote, will get exciting again, but didn't give any specific timelines for his nebulous call. Still, he maintained the thought process that if 1200 is breached, Bitcoin will start to experience a loss of its user base, even diehards. The trader recently sat down with Cointelegraph to also discuss his expectations for the cryptocurrency market. Interestingly, the Factor chief explained that he's becoming a, quote, long-term buyer and holder of Bitcoin. However, in an apparent Bitcoin maximalist outburst, Brand noted that he has, quote, no time for old coins or macro caps such as Ethereum and XRP. Oh, man. Oh, this is an interesting one, too, which we'll probably go into next. So, yeah, there was a little alternative perspective with regard to cryptocurrency. However, I don't think we're really going to see $1,200. I think that call is a bit well below the mean. Not to say it's not possible, because this is crypto, so anything is possible, even stuff you don't want to happen. But I don't see that, though, as being the end of the story with regard to the price fluctuations on Bitcoin. If we do see that volume of a price decrease, I do expect that we will see a relative increase in the value of altcoins. Now, as far as possible reasons for this to happen, well, one thing that has happened in the interim between when Bitcoin spiked and now has been that the transaction volume on the network has significantly decreased. This isn't to say that we're back with intolerable levels, even with a 1 megabyte cap on the block size limit, but that it has gone down a significant amount. And so for for those that are looking at the transaction fees and thinking that they're going to last for any duration of time. I just have this to say, that the volume has been going down, but the transaction price, it hasn't gone down to like match the decrease in volume. And that I expect, because we haven't seen a block size increase, that if we do see any significant amount of adoption and we do see any significant increase in value, that what we're going to see is a significant uptick in the transaction fee cost. And this I think is one of the reasons why we're seeing such a pump in custodial services, or interest in custodial services, is because people are looking at it down the road and they're saying, we want to get ahead of it and we want to be the third party intermediary between you and the blockchain. And so the thing to be doing right now is to accumulate Bitcoin so that you can act as a reserve of Bitcoin to be transacted by other people. And of course, to reward yourself with fees. But I think that what that might also cause is a distraction in mining, that people will be looking at the amount of transactions happening on these custodial services and saying to themselves, these should be transactions that are happening on chain, and the miners should be the ones getting rewarded for them, but they're not, because all of this transaction activity is happening on quote-unquote side chains that are ultimately mined by the Bitcoin miners, but that they're not giving full credit for. And so I think that what that's going to do is that's going to cause additional interest to shift into altcoins, both on the mining end and in the transactive activity end. Now, whether or not Ripple will be one of those, I couldn't tell you, but I don't really think it will be, because a lot of people in the crypto sphere view Ripple the way that they would say a stable coin. It's kind of a joke. Anyway, this is on EthereumWorldNews.com. Brad Garlinghouse. If Ripple shuts down, XRP will continue to trade. These guys have been trying to tap dance between being called a quote-unquote cryptocurrency and being a company. And they've tried to disassociate the two, like that they're actually representing Ripple or something to that effect. Anyway, continuing on. This is by John P. Nijui. My apologies on that pronunciation, sir, but definitely yes. Penis. This is authored December 19th, 2018. The CEO of Ripple, Brad Garlinghouse, recently sat down for an Ask Me Anything AMA session with the company's senior VP of marketing, Monica Long. The AMA discussion took place yesterday, Tuesday, the 18th of December at 2:30 p.m. Pacific Time. If Ripple shuts down, XRP will continue to trade. In the AMA session, currently available online, Ms. Long and Brad Garlinghouse, whether XRP is a security or not. Ms. Long also acknowledges that this has been a question that the Ripple CEO has been asked on many occasions. His response to the question, Brad Garlinghouse, states the following. I think it is very clear XRP is not a security. There is a whole bunch of base layer reasons for that. One of the most important I think is if the Ripple company shuts down, the XRP trades on over 100 exchanges around the world, and XRP will continue to trade. Ripple is one important participant in the XRP ecosystem, but there are a whole bunch of participants. 2018 saw little participation of institutional investors. In the AMA session, Brad Garlinghouse also stated that his 2018 prediction of institutional investors getting into crypto investing will have to be pushed to 2019. One prediction I made that I think I got wrong, I really thought 2018 was going to be a year where you saw an increased participation in the digital asset markets from institutional investors. I think we haven't really seen that. To the extent that we have, it has been in very, very small amounts. That's not true at all, as communicated previously from Grayscale's holdings of 208,000 Bitcoin. That's a lot of fucking Bitcoin. I think we really haven't seen that to the extent that we have, blah, blah, blah. And I think it's largely because the industry hasn't quite matured to the point where they can participate. Bullshit. Dominate is more like it. So I'm going to push that prediction off to 2019 as we look forward to next year. SEC has a hard job deciding on a Bitcoin ETF. Brad Garlinghouse also provided his insights on the pending Bitcoin ETF decision at the SEC. Due to the sensitivity of an ETF, the CEO of Ripple acknowledged that the SEC and the United States has a hard time with regards to the matter. The regulatory body has so far hinted that their major concerns are risks associated with the manipulation of a Bitcoin-backed ETF, which is high. Mr. Garlinghouse also added that 2018 has not helped with the tasks given to the SEC, and that we saw more concentration of Bitcoin mining power. Such centralization power increases the risk of manipulation. Yeah, on the side of the protocol, not necessarily on the price, unless of course you're talking about them holding back in their own self-interest, which they are free to do. Continuing on, more on the AMA with Brad Garlinghouse and Monica Long can be found here. What are your thoughts about blah blah blah? Yeah. My thoughs are that, so what? An institutional investor made a comment about other institutional investors. But yeah, I think that he's incorrect. Because, like I said, Grayscale, according to this article that we read earlier on Ethereum World News, it says that Grayscale owns 1% of all the Bitcoin out there right now. Now, why the fuck would they have such a high concentration of Bitcoin if they didn't see some sort of future in it? I mean, I'm sure they're not going to be dumping at 5,000. I mean, if they are, we'll notice it, though. But yeah, as far as institutional investors, I've already said multiple times on the show, I think they're hodling in the background right now. They're expecting for a transition of Bitcoin traffic to happen mostly on the Lightning Network, and they want to be liquidity providers on that. They want to be hubs. They want to be third-party payment service providers on a network that was designed specifically not to need third-party transaction processing providers. I mean, transaction service providers. We don't need them, you know. But yeah, I think that in the longer term, what's going to happen is that the people that have always been interested in cryptocurrencies are going to double down on their interest. I think that even the quote-unquote hodlers that have been sitting back and just watching their bags rise in value, that they're going to be getting in a more active sense over this next year. I think the current lull that we've seen as far as an interest in mining, I think it's temporary. I mean, like, really temporary. And that the current glut that we're seeing of mining cards on the or mining capable cards on the market is just a temporary reflection of a temporary issue. And that as we go forward, like I said, I think that Bitcoin is going to define for the market a significant need for alternatives to it. That they're going to see the regulatory capture that's enabled by things such as the Lightning Network, because there's going to be an additional interest in actually applying all that money transmitter regulation that all the nations and all the states out there have been trying to craft for themselves. Now, this is just an extension of what I've talked about before on this show about cryptocurrencies being the mad quagmire of the 21st century. I still believe that is the case, that we're looking at a case something like the Cold War between the US and Russia, except it's in cryptocurrencies now. And it's not just a matter of who's doing the mining, but also who's doing the transacting and how. That cryptocurrencies, for the most part, provide us with a new field of play for the global economy. And we've seen before where cryptocurrencies have been used, and still to this day, in the stead of fiat currencies during times of economic distress within a nation-state's borders. This is not going to stay specifically within the nation-states that are currently experiencing this. That there are several fiat issues that we are yet to experience, and that cryptocurrencies in all of their form and luster will be one of the places people shift to continue doing business. And it is with that I'd like to close out this episode. We will be back again, I believe, on Friday. Let's see, Friday will be the 21st. Yeah, we'll be back on Friday at 8 p.m. Pacific Standard Time. And so until then, I'd like y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. And as far as our last dance, I haven't really decided on that yet. So kind of leave that mystery up to the last moment. And we've covered a lot of the stuff that I did want to play tonight. I mean, I had been kind of lax on my Slayer. You know, it's one of those things that I like to whip out every once in a while. But this one, I think I'll dedicate this one to all of the new crypto investors and new miners that we expect to receive, or at least I do, over this next year. And so to you all, our last dance, strapping young lad, all hail the new flesh. Last dance here on Coin Metal. Thank you very, very much for listening. As usual, you can find me on Twitter, also Facebook, and in the Discord and Telegram chat rooms for Verge Currency. And so until Friday, y'all have an excellent evening. Good night.